It's that time of the year again, tax planning. With the financial year end around the corner, all of us should start planning our tax savings now. Every day, we put in all our efforts to get that one paycheck at the end of the month. But we are shocked when we receive an amount much lesser than expected due to all the tax deductions. Isn't that disheartening? Putting in all our hard work just to pay a heavy amount as tax? In this video, I'll show you how you can save on taxes on your paycheck. First and foremost, as a salaried employee, you should know your tax slab and the meaning of your salary breakup components. This will help you figure out how to save on taxes. Let's talk about two regimes that are there in tax computations: new regime and old regime. Let's look at the different tax slabs under both the regimes. New regime has lower tax rates compared to the old one, but in the old regime, there are a number of tax exemptions that you can avail to lower your tax liability. The new regime does not allow for any deductions under any section of the Income Tax Act 1961. Now, let's look at the deductions you can claim and how. You can claim for deductions under various sections. HRA, Housing Rent Allowance, by showing a proof of rent you are paying in case you're living in a rented property. Under Section 80C. Under Section 80C, you can claim up to Rs 1.5 lakhs as tax deductions in one financial year. How can you claim it? By using the following investment options. Number 1. PPF. You can invest annually or monthly in a public provident fund. But one thing to know is that the returns are fixed at 7.1% only. Tax saving fixed deposits. These are just like normal fixed deposits but are specifically made for tax saving purpose. The cons here are the lock-in period of 5 years and low interest rate that ranges between 5.5 to 7.5%, and this does not even beat the inflation rate. Tax Saver Mutual Funds, also known as ELSS, Equity Linked Savings Schemes. These are the best investment options to save taxes. The lock-in period is only for 3 years and they generate around 15% annualized returns. Section 80 CCD, NPS, National Pension Scheme. You can claim a maximum of Rs 50,000 under this section. Now, there are lesser benefits for NPS and there are multiple restrictions for withdrawal, investments, etc. Also, it does not serve for any purpose other than retirement. Now, are you confused as to which tax saver mutual fund to choose? We have top 3 funds according to the EduFund experts. Canada Robeco Equity Tax Saver Direct Growth Fund. This fund has generated 15.97 returns since inception. It has an AUM of more than 4,000 crores. If you would have invested 10,000 during the fund's inception in 2009, it would have been around 1.15 lakhs as on 24th November 2022. Bank of India Tax Advantage Direct Growth. This fund has an excellent performance quality and has generated a return of 17.67% since inception. It has an AUM of more than 600 crores. Rupees 10,000 investment during inception in 2009 would have grown to Rupees 1.09 lakhs as on 24th November 2022. Mirai Asset Tax Saver Fund. This fund has generated consistent returns throughout all time horizons. It has generated 18.24% returns since inception. This fund has an AUM of more than 13,000 crores. Investment of Rs 10,000 at the time of inception in 2015 would have grown to Rs 31,845 as on 24th November 2022. While choosing any tax saver mutual fund, remember to always make a lump sum investment keeping in mind the lock-in period. Because if you do a SIP investment, the lock-in will continue from the date of the SIP investment made. Yes, these are not direct recommendations. Please contact a wealth expert from EduFund to know which investment option suits your portfolio and let us help you save taxes.